This is The Convergence.
All right, everybody, welcome back to The Convergence. I again have Matthias Weissl with us. We're going to continue our conversation about Web 3.0 and all the great work he's doing at Verum Capital. Welcome back. I know we only were break there for 10 seconds, but it's good to have you here. We've been talking about tokenization. We've been talking about DAOs and some of the projects that you work on with Verum. So just to give everybody a little background, if you didn't listen to the last episode, 5-year-old venture, you would consider yourself a venture studio, right, Matthias?
That's correct, yes.
Yeah. Based in Zurich, have worked on dozens of projects over the years in blockchain and crypto. And we talked in the last episode about water DAOs, which was really interesting, creating a tokenization of the extraction rights. And then we also talked about how we might be able to tokenize things like intellectual property to bring other stakeholders into the equation that may be the downstream stakeholders. Maybe it's something like a medical procedure or a medical advancement that would benefit you and giving you a voice in that process. So again, thanks for being with me, Matthias. Let's talk a little bit about how about other projects that you all have worked on. You know, we've talked about water, we've talked about intellectual property. What are some of the other areas that you've dabbled in and feel like there's a future?
Yeah, we've talked about the simple tokenization. We've talked about DAOs, so community structures. I think it's time to talk a little bit about the financial side of things, about decentralized finance. And I'm happy to dive a bit deeper here. And,
let's do it.
Stop me when I need to stop talking. So we have an example of a venture that is generating real revenues while empowering users to participate in a fundamental aspect of decentralized finance. And this is called liquidity provision. It helps to reduce really the barriers for everybody, for everyday investors, by ensuring they're protected against market volatility. And obviously, you know, the market is highly volatile.
I haven't looked at it yet today, but I'm sure it is.
And what this venture is, it's a decentralized exchange for derivatives, and it's using an on-chain order book that makes transactions transparent and inexpensive. The first product will be really the issuance of weighted variance swaps, and this will create a product.
Okay, you have to explain that weighted variance swaps. I know I have a lot of financially smart people listening to this, but for those of us who aren't, tell me what that means.
Yeah, I think nobody on this call needs to know what this is. I think it's only important what it does.
There you go. That's smart.
What it does, this financial product, the issuance of puts and calls, it helps the liquidity providers, which I mentioned earlier, to hedge against impermanent loss. And impermanent loss is one of the most important elements in DeFi. And everybody needs to be aware of impermanent loss. What is IL? It's basically it's what happens when the opportunity cost of providing capital to a liquidity pool in decentralized finance that facilitates trades on automated market makers outweighs the cost of simply holding that capital. It happens when there is market volatility because the liquidity pool wants to keep a token pair balanced or some other reason. And it's a really important and pressing issue that needs to be solved. And this is exactly what we are doing. It allows automated market makers to function and work without centralized market makers, so that the decentralized exchange can truly be decentralized. Again, we have, if things are centralized, often corruption, power, abuse, and so on happens. We know that. And therefore, impermanent loss is a real problem for barrier of entry, because, you know, in the first 6 months, let's look at some statistics maybe that puts more context to this. In the first 6 months, Uniswap V3, the largest DEX by TVL, total value locked, liquidity providers earned more than 190 million in fees. But nevertheless, they suffered in 260 million in impermanent loss. Therefore, therefore, if people only see the 190 million, it might seem attractive. But if you don't look at the impermanent loss, it's a problem. And we, after having done some research, we estimate that this translates to around 800 million in losses for LPs across major DEXs in the same period. Now, obviously, I can go into more detail what this would.
I'd love to hear this. This is very fascinating to me. I love the whole put and call kind of concept. I've actually tried to incorporate that into some investments in the past, into startups, and it's really hard to do on paper. But you got me really thinking here. So please continue.
Yeah, and if you look at, we've done obviously some research here, and a research paper published by ETH Zurich, the number one university here in Switzerland, found that liquidity provisions are offered only by a few addresses, by a few wallets. In total, according to this paper, I think it was 183,000 that provide liquidity on Uniswap. That was last year. So by now, I'm sure it's more. Sure. So the average number of pools that participate is 1.4. And the problem is 96.5% of the accounts reserve their money in no more than 5 pools. So the paper basically says that the bulk of liquidity is being provided by regulars, non-whale investors who stick with 1 or 2 pools. And that means that over 80% of liquidity pools have token paired with ETH. So if we take the most stable common pool, wrapped ETH USDC, we calculate that the average LP in Q2 2022 earned about 4,997 in fees per year, but suffered 8,366 in impermanent loss. Even when we ran our simulations, it didn't really help. And in that case, the cost of hedging in our solution in this venture here would be $630, offering the LP a recovery of 7,735. So it's a pretty good, good setup. And yeah, I think this is a highly interesting venture that we believe has a lot of opportunity.
For sure. Just so that we can step back for a second, in case anybody doesn't understand liquidity pools, I'll give my quick explanation, and then I'll allow you to do it because I'm sure yours will be a lot better. But when you're doing tokenization of something, there should be some reserve. Tokens shouldn't really be a fiat currency in the sense that there's nothing backing it. It's not just the full faith in the people behind it. There is a percentage of the funds collected that goes into a liquidity pool that essentially is, in a lot of senses, that sort of gold in the in the vault someplace that protects those investors. How did I do, Matthias? Am I good? Is that too simple? Is that a little too complicated?
Derrick, you're hired.
All right. Well, I just learned this a couple of weeks ago myself because I made an investment into a token company that I'm going to have here on the show in the next few weeks that's doing some mental health care work. And they've created a token that you can use to redeem for services. And I'm watching I'm asking where the funds are going, and they're like, well, part of your funds are going to this liquidity pool. And I'm like, okay, tell me. Amazing. So that was the way it was explained to me. So I guess they did a good job.
That's great, Derrick. So I think this is definitely a challenging topic. Maybe that deserves an easier topic followed on that. Or what do you think, Derrick?
All right, we might have went a little too deep. Let's bring it back now. So what's another project that maybe is a little easier than liquidity pools and hedging and impermanent losses?
Let's go away from finance.
Okay, let's do it.
That it's a bit interesting. So let's take licensing. Licensing, in traditional licensing, the buyer, in my opinion, always loses. He's always the loser. He or she is always the loser. Why? Because they're the ones conducting the upfront payment. They're the ones that need to commit for a certain time period for this license. If some of the services goes wrong or does not work, the buyer is the one that needs to take action and be the one stay on the line for hours on the phone saying, hey, please, I want my money back. Often then speaking to service assistant, who's not very incentivized to actually give you the money back. Realistically, they are actually incentivized to not give you the money back.
Absolutely.
So in what does that mean? As you can tell, there's a misalignment of interest, and if he or she pays too much, there's often no reimbursement. So what we've been thinking about this for years, and we've never really found the right time or the right use case to really create a venture. But now we did over the past year, and it's what we call it is pay-per-second functionality via a smart contract. So
okay, say that again. Pay-per-second functionality.
Pay-per-second. So pay-per-second. Let's leave it as pay-per-second.
Okay.
You pay only when you use something. That's really what the gist of it is.
Sure.
The consumption of, let's say we're speaking of Netflix. Let's not speak about our specific venture. Let's speak about Netflix. Yeah. Netflix charges you a monthly subscription fee, probably soon yearly or whatever it is. The problem is there's a huge barrier of entry, because for people that don't know what on Netflix is, that have never heard about it, they're not willing to pay X to commit for 12 months to be a part of Netflix. So that's a problem. So what we have done, basically via a smart contract, consumption data is tracked. So every minute that Derrick spends on Netflix, the data is fed via an oracle to the smart contract, and it says, okay, Derrick is only paying per second. So for every minute you're watching one of your favorite Netflix shows, I'm not going to call you out which one it is this time.
Hey, Ozark, I just finished. I've got a bunch of them, so yeah,
Love Ozark. Okay,
make me sound cool when you say Ozark, right? Because everybody's like, yeah, that's good, right?
Yeah. So you will only pay every minute you watch of Ozark. So I personally would love that, because first of all, I don't have to pay $20-$30 per month guaranteed, because what if I'm on vacation? What if I'm sick and I cannot watch? And there's a ton of idle credits laying around that I have. So in our solution, I will only pay per second. And the idle time credits that I have, I can lend to people. So let's say I go on vacation for 2 weeks, I don't have internet, and I give you, Derrick, 2 weeks of licensing time to watch Ozark. You'll be happy because you've never watched Ozark. You will be hooked immediately. Netflix has won a new customer. I'm happy because you're giving me my cost or partial of my cost back, and you're happy because you like Ozark. And overall, it's a complete alignment of interest, because if the content is good, the revenue will be better than actually in traditional subscription model. Because when I'm hooked, not me, unfortunately, I don't have time, but when people are hooked, they watch 24 hours of Ozark in once.
Yeah, right, yeah.
So it's actually perfect for video licensing, and that is only allowed via smart contracts. And that's what we have been building. So it's a simple technical solution. Ideally, it's going to be just a button that you press, say, pay per second.
I love that concept, because I got to tell you, I don't have... My wife and I, every night, we're both working on our computers, but our sort of time to get together is right after dinner. We're sitting on the couch. We want something that's sort of mindless. We play a series and we're working while we're watching this series. But I got to tell you, as we have gotten more suggestions from people, oh, hey, check this one out on Apple TV, check this one out on Paramount, check this one out on YouTube TV. Now, all of a sudden, I'm probably paying more than I was back when I had cable, because I've got 10 different subscriptions, and most of them, all I'm really interested in is one show. But because of the way the algorithm works, Apple TV is a great example. Somebody told us, watch Ted Lasso. It's one of the greatest shows. And I have to admit, if you haven't seen Ted Lasso, that show you could watch like 3 times over and over. Okay. It just has this great European-American connection between, the cultures, between the difference. But we started watching Ted Lasso, and then that turned into us, it suggested Loot, and we started watching Loot, and then we started watching C, and then we started watching Morning Show. And you're right, very quickly it became, but our initial interest was, I would have bought, versus signing up and then having to cancel, because I do this too. I'll do the HBO Max for a month to watch something and then cancel it. It's like, wouldn't it just be better if you let me consume as I go? And candidly, I might consume more. I might eventually reach a point where I say, you know what? I want to be a full-on subscriber for $14.95 a month, because I'm consuming enough now that it makes sense. I love that. I love that this sort of entry point for customers to come and do a little bit of business with you and get this, experience before they make that full commitment, because I do believe that there's a lot of people that are turned off by that. I am. Yep. I mean, I don't have HBO Max all the time. I get it once a year for a month, and then I cancel it when my free trial's up. I love that concept. I think you can absolutely see how that would work in this consumption-based model. Makes so much more sense. So I want to talk with you for a few moments about Evergreen Carbon Credits, one of the sponsors of this show. I started working with Evergreen when I was telling a friend of mine who's involved with that company about my efforts to try to learn more about blockchain, NFTs, crypto, all the things in this space. And he showed me Evergreen. Evergreen was a really unique solution. I've looked at carbon credits in the past. I've been in the sustainability industry for almost 15 years. I understood what they were. You were buying an offset to offset the carbon footprint that you or your company has. But I also understood the challenges with that. They're sold in very, very large blocks, and then people break those blocks up and try to sell individual credits or small clusters of credits to businesses. And that creates some room for fraud, for people to not be up and up on what that project is, if that carbon credit is real. And there's challenges with that. And you can Google it right now and find there's a big case in Europe going on about fraudulent carbon credits. But what Evergreen did, I thought, was really unique. They took this idea of NFTs and they took blocks of carbon credits and broke those things down into tens of thousands or even millions of individual carbon credits. They can actually fraction those even out to a tenth of a carbon credit if they needed to. And they were able to then create a smart contract around that carbon credit so that you can track it back to its origin. You can find out what project it was associated with, but you are also guaranteed that the carbon credits you're getting from Evergreen are the real deal. You get that certificate, you get that certification that only the blockchain can do. So that's why it made sense for them to come on as a sponsor of this show. We're talking about all this new technology, and with new technology comes higher energy usages in some senses. And Evergreen is here to help offset that. If you want to look to maybe improve your image in the marketplace, maybe you're looking to offset some of your carbon footprint, not even just for your image, but actually for the sake of the planet, head on over to evergreencarboncredits.com and check out what they do. You can buy credits for as little as $11, and you'll get the certificate and the NFT that you can put in your wallet that shows that you've actually made that contribution. And that money, particularly right now with the projects they're working on, is going to reforestation in the Amazon. I think that's something we can all really get behind, particularly when we understand that the environment, the climate we're all connected to it. It doesn't matter if we're putting off emissions here in the US or if it's happening in Mexico. It all contributes to the same global problem. So why not be part of a global solution with Evergreen Carbon Credits? But from what you're seeing in the marketplace right now, where do you see this next cycle going? What do you see the next 5 years?
I think we have to, if fine for you, Derrick, I think we have to take probably a step back and put some context of the previous cycles, because that gives more context for the future. Sure. And I think the crypto market, it develops in cycles. Obviously, we know that these cycles appear very chaotic, especially if you're watching from the outside. Yeah. But in reality, they have an underlying order, in our opinion. The market has evolved in 4 waves from 11 to 2013. Yeah. From 14 to 16, like 11 to 13 is basically Bitcoin is here. Well, 14 to 16, Ethereum. Hey, there's more than Bitcoin. There's more than just a peer-to-peer cashless transaction system. Right. Then you have the third wave, 17 to 20, which is ICO boom. And then you have 21 to 22. Is basically we had DeFi and NFT boom happening. And across all these 4 waves over the past 10 years, there's been a steady increase in developer activity, which is our most important metric. Sure. It's all about developer activity. We look very limited, if not at all, at market cap. So we don't really care about that.
Which does make some sense. I mean, you're putting the cart before the horse if you're just thinking about market cap.
Exactly, especially in such a speculative environment. Yeah. Right. Okay. And in each of these waves, we saw driven interest, fueling new ideas, new startups emerging, and so on. And we basically, the good thing is, when the prices start to fall in one of the corrections between these 4 waves, only the strongest projects survive. So there's immediate natural selection happening, if one could say it that way.
Yeah.
So therefore, often only the good projects will survive over the years, which is great. And we had to see this the hard way at Verum Capital. We've never taken on outside capital. We had to build up our own P&L. We had to build up our own balance sheet. We ourselves remain accountable for everything that we do. And for us, it's tough to predict now going forward. Now, we follow a narrative, or we follow narratives with a critical perspective always. We can't really pretend to know what the future will look like. But we saw, we learned individually in the first wave. Verum was born in the second wave. We were realized in the third wave. We realized a lot of things and also learned. And we were lucky enough to grow tremendously in the fourth wave. And obviously the length of the operations puts us in the forefront, but in reality, we still don't believe that we know a lot. Web3
when the cycles are that short, it's real easy to get caught, right?
If anybody calls us an expert, no, we're not. By no means we are experts. And but we're trying to operate with a breadth of focus of exploring ventures in many new avenues. And what we see is that we think that there are efforts that test the boundaries of the space and create new knowledge now happening, but they don't necessarily concern themselves with bringing others along with them. So which is an issue. Unfortunately, I have to say there's a lot of pump and dump happening that really has become critical. And we've worked very hard actually to navigate away from optimizing flawed metrics to pump up the perception of value in our projects. And yes, as you can imagine, lots of projects have tried that. It happens everywhere. Yeah. And so we've really worked against that. Or also when projects try of creating unsustainable flywheel effects.
Tell me what you mean by that.
Yeah. So there is obviously, we've talked a little bit about liquidity providing, staking. Flywheel effects are often made up token economics, where the value of the company only goes up on a market cap. The value of a company only goes up if the overall market cap or the overall demand of buying ICO projects goes up. It has nothing to do with the underlying value that the company creates, and this needs to stop, obviously. And now,
it's true. And let me just interrupt in there really quick. It's funny you mentioned this because the token that I just recently invested in, the company's not even launched yet, right? They're still working on the product. They're still doing these things, but I'm looking right now today, I'm up $20,000 on that investment solely because it's pegged on Ethereum and Ethereum's price has increased so dramatically that I'm sitting here going, wow, I'm up, 50% on my investment. Yes, but I'm not up 50% on my investment. I'm up 50% on what things are pegged to, which the problem is if that's all it is, then it really, I should have just bought the Ethereum direct.
Yeah, exactly. But that's very interesting. So first of all, I can learn a lot from you because my investments are not up that much, but that's okay.
Well, I'm sort of shocked. I'm looking at it right now and I'm like, I just happened to open it up and I'm like, Ethereum must have done a lot better in the last 3 weeks or 4 weeks, which I know it has. But I think I got lucky on that one.
Speaking of Ethereum, I think this is really, I think what's happening now, this is the most important thing probably on this podcast. What's happening now, and whether you're inside or outside of the space, there are really two critical moments. For the space that you're probably talking about. That is probably the collapse of 3AC and Celsius that led to billions in value being destroyed, and the merge. Ethereum's move from proof of work to proof of stake. And we think these critical events are really forcing everybody, no matter how peripheral, to the space that they are to really confront the dominant narratives of the bull market and write new ones that will allow the space to evolve. Because point one is really there has been a crypto 2008 moment. There was a crash.
Yes.
73 billion was tied up in DeFi applications in June 2022. It's down 71% since December. Major players, Three Arrows Capital, Celsius, bankrupt. Shock waves that a few players collapse sent through the space was huge. Because billions of dollars in value was destroyed, and the fact these ripple effects were more like a monsoon. We think that revealed a critical flaw in the way DeFi has been operating. And how has it been operating? The concentration of capital undermines its decentralization. That is really an issue. Yes, decentralization, everybody talks about it, but the concentration of capital in a way works against that. And Celsius was integrated deeply in many services, including the major lending protocol called Aave, who relied on Celsius for, I think, around 30% of staked ETH. Similarly, 3IC is a lead investor of staked ETH provider for Lido. So that is...
so it got a little incestuous there, didn't it? Because decentralization should mean it's decentralized instead of somebody starts to centralize all the decentralized assets, and the next thing you know, here's what you have.
But more importantly, looking ahead, it's about to be September, and we all know what's happening in September. It's the merge. And that is really the big deal.
So let's talk about the merge. Explain to listeners, because this episode will be coming out probably right about the time of the merge. So explain the merge.
Perfect. So on September, probably 14 or 15, it's not 100% sure yet, Ethereum network will transition from proof to proof of stake. So from proof of work to proof of stake. When the beacon chain and the main chain will merge, the issuance of Ethereum will be reduced by 90%, which is huge. So two chains merge, issuance of Ethereum will be reduced by 90%. What does that mean? Current issuance for mining rewards around 13,000 ETH per day. The current issuance for staking rewards is 1,600. So we have 13,000 once, and then we have another time 1,600. Okay. After the merge, only the 1,600 per day will remain, dropping the total new ETH issuance by almost 90%. And therefore, the burn rate of the merge at an average gas price of at least 16 Gwei will be at least 1,600 ETH per day, which effectively brings net ETH inflation to almost zero. And that is quite interesting. As people watch, I would say arguably the most important protocol in the history changes network consensus in real time, and we're all a part of this, which is super exciting. And we are reminded of a few things that additionally, the move towards a more sustainable operations in terms of the environment, security, economics, and financial assets are worthwhile, mainly sustainability. And that's really exciting because of mainly inflation. I think inflation is not only a very important topic in the traditional finance world these days, but also here. Because if we look at, I think we need to break down inflation. I'm sorry if I'm diving a bit too deep here, but
no, it's very good.
We need to break down inflation here on the execution layer issuance. So estimating at 2.8 or just roughly above 2 ETH per around 13 seconds. There's 4.93 million ETH issued in a year. 4.93 million ETH issued in a year. Currently, inflation is around 4.13%. Okay. This includes also some minor changes, but around 4.13%. And if the second point is the consensus layer issuance. So we talked about the execution layer issuance, now the consensus layer issuance. That is around 13 million total ETH staked. The rate of ETH issuance is around 1,600 per day, which I just said. And this results in 584,000 ETH issued in a year. Therefore, currently inflating at 49 basis points.
Yep.
Now, post-merger inflation breakdown, the total ETH supply is, I think around 119 million ETH.
Yep.
And the execution layer issuance is 0. Mm-hmm. The consensus layer issuance is the same at 49 basis points.
Yep. And
therefore, the total annual issuance rate is 49 basis points. And the net reduction in annual ETH issuance is 89.4%.
Wow.
So in 1 year, we have the most catastrophic event in the history of crypto, which is not very long. So not a good fit. Moving us into the biggest bear market, but also making the biggest change to the biggest protocol there is out there. Yeah. So for us as a company, there has been an immediate shift of focus. Keeping capital decentralized is important. That's one point that we always keep. And finding mechanisms and appropriate metrics for sustainable growth, which is important. Because, or in other words, we saw a lot of valueless governance tokens. We saw a lot of subsidizing yields. Marketing budget has gone into yield generating for clients, which is a scam. We saw a lot of optimizing for a standard signaling metric. We saw a lot of pumping value through token emissions or worse, Ponzi dynamics. And that all of these are at best unsustainable. Yeah. At worst, a recipe for disaster. Yeah. And when done legally and ethically, these approaches have enabled some great experimental projects, maybe, but they won't fuel long-term growth and adoption. And yeah.
Wow, that's great stuff. So the merge, I mean, if we want to summarize the merge, moving to proof of stake for Ethereum means that the supply essentially will go down with the demand sustaining or increasing, which is usually a good sign for any asset, right? I mean, is that a good summary? Is the supply will essentially be a little bit more fixed? Or, I mean, there's still mining that's going to occur. It's just the amount of mining will be less, right?
Exactly. You can compare it to really printing money. The amount that will be printed is different. Yeah.
So do we look at this like a I don't want to call it a stock buyback, but I mean, essentially the supply is being diminished in this process.
Yes. One could argue that this is similar to what is happening, but I have to say in the merge there's like 10 different things happening simultaneously.
Yeah, sure. So I'm trying to figure out the easiest way to explain it.
Financial product. It's a technical product. It's financial. There's code behind this. So,
but in the end, the supply, what these adjustments are doing is creating. It's not burning anything off per se, but it is essentially limiting the supply. Yeah, which is usually a good thing, right? I mean, if you're a commodities trader or we all understand it. We just had a big in the news here yesterday in the States was, people, the Biden administration retired a bunch of student loan debt for people and just said, hey, if you have student loan debt, we're going to just retire $10,000 of that. And people are falling on both sides of the political spectrum. My side is, here comes more inflation because, all you really did was just do a math transaction, but that math transaction, 1 + 1 eventually equals 2. So there's going to be a fallout from that anytime that you print more money and put it into circulation. Very interesting. So what else? What in conclusion? I mean, I think we've gotten really good here. We've talked about projects. We've talked about the future. I mean, obviously, you're still very bullish on the future of crypto and blockchain.
Yes, exactly. And by explaining the merge, I'm not bullish on one chain.
Right. Yeah. Sure.
We are chain agnostic. We've worked on so many different chains. We've seen what works and what doesn't work. And yes, we're super bullish. Obviously, I mean, we're fully committed. Our whole team is really not only passionate but also almost a little bit obsessed about some of these principles. And what we see is really a new emerging narrative that we're interested in. We are interested in the future, and it has yet to be proven, of course. But the idea is really around real yield.
Yeah.
So not only. So what that basically means, when contextualized, it's an appropriate response to what has happened this year. I would say generally it refers to the practice of allowing token holders to stake or lock their tokens to access a share of the protocol's revenue, maybe, but that something is pegged to a real value generator, not to a market price, not to a perception.
To a meme.
what utility are you generating? And typically, denominated also in mainstream assets, because if you denominate it in different assets that are not mainstream, then again, there's some scam-like mechanisms that have happened. And what interests us most in this narrative is really that the projects are that are doing it, they seem to be the most they seem to be themselves most critical about this term, which suggests that these efforts go far beyond marketing plots and hashtags, etc. And the good thing is also that derivatives exchanges are leveraging these tactics, which has a lot of relevance for some of our projects, because you're mitigating risk. You're allowing normal people to come in and not take their money. You're supporting normal people to actually be enabled to be a part of the ecosystem. And if it focuses, or if there's some focus, some user or investor attention on the P&L, I think this is also important, that users, investors, they should not only look at the market cap, they should look at the P&L, they should look at IP, they should look at team, they should look at real yields, they should look at, ideally, encourage projects to be more transparent and how they allocate funds, because there just simply has been too much in the past that really left a bad taste in people's mouths. And I mean, if we just do the comparison with the traditional world, which is around dividend signaling in traditional finance, in TradFi, this exactly has happened in DeFi as well. Yeah. And that wouldn't have happened if full transparency would have been there, if not some Ponzi schemes would have been there. And and what we really also see, if projects, and this is the last thing to say here, if projects really can't find natural adoption without insane incentives of promising APY that is not sustainable, it's probably not a good idea overall. And it's probably not a good idea to redistribute the capital.
Well, you've really got me here, because I got to tell you, in essence, what you're saying is that all of the fundamentals of good business, all of the things that we should be looking at, not the stock price, but the P&L, all of those determining factors are still just as important in the crypto and blockchain markets as they are with every other asset, as it has been since the creation of currency. And this is something that we forget. I trade a lot, and I have to be honest, I am not as deep on research. I follow a lot more trends. I might go look at the financial statements if I'm making a significant investment, but for the most part, I'm looking at the trend line and I'm trying to buy dips. And the reality is some of those things, and I think the meme coin concept that has come out, in the crypto spaces, I jumped on it too. Now I guess I'm wise enough now in my old age that, I'm not going to put a significant amount of money in a meme coin, but I do unfortunately feel the pressure myself, even as somebody who I would consider savvy and looks at, does a little bit more research, Shiba Inu come out and I'm like, put $1,000 on it. It sucks. It feels like it's a roulette wheel sometimes, where all you can really do is bet upon, put money on red and black and hope for the best. I know that's not a good investment strategy, but unfortunately it's worked. So it's but I think that's what, to your point, it comes back down to fundamentals. It comes back down to utility. That's what these cycles do. And I think of what we just recorded, I think the takeaway here is there are cycles just like there are in anything else. And the core fundamentals of any asset, of any holding, always comes down in the end to utility and what's that bottom line look like. And if you're missing one of those two, it might grow in value, but it is not a stable investment.
Yeah, 100%. And people will get lucky, and this is totally fine. This is part of any new innovation. And the thing is also, if you feel sometimes like sometimes you don't have an overview of all the things that are happening in crypto, you're not alone, because we're a blockchain crypto, we're a Web3 venture studio, and we don't have an overview of everything that's happening. So how could a single investor even have an overview? It's not possible. But that's fine. Those are all the upside and the downside of a completely new way of doing business. As
I've always said, and I've raised money for lots of different companies over the years, and I've always said, look, sometimes there's what we call rodeo investments, and it's, look, we're getting on it for the ride. We don't know if we're going to get thrown off in 8 seconds or we're gonna conquer the bull, but we're getting in it because it's fun. And sometimes it is fun. I have to admit, I look at my portfolio, and there are things that I hold in my portfolio that I'm just like, I bought that thing at $1 and it's trading at 30 now. And the fundamentals still aren't there, but I'm just like, I want the story. I want the ability to say, hey, I was there. Now, I don't have a significant amount of money in those things. Where my money sits is in all the ones where the core fundamentals have been very, very well vetted. Yeah. Although I should say, Warren Buffett, come on this show, because I need to give you a piece of my mind. I don't know what happened with you this last year, but man, every time I look at my holdings, anything that Buffett touches this last year has turned to shit. So I'm just like, well, even the core fundamentals of a great investor like Warren Buffett can be challenged in the end.
Yeah, exactly.
But I still hold those assets because I understand those are based on those core fundamentals. Yeah. The short-term return sucks, but in the long term, I know, and I'm still dropping my basis on those by putting more money into them because I get it. And I understand that in the end, what tends to win is the P&L.
Yeah.
I love it. Cool. Matthias, thank you so much. Tell listeners how they can find you. It's Verum.capital, right?
Yeah, sure. I mean, we're actually quite private on that. We don't do much marketing, but it was so great, Derrick, to be on the show. I worked for your cousin in Munich, and it was really one of my best experiences ever. I'm so grateful to have met your cousin. And
it's incredible genetics. That's what we have. I always tell him that. I say, look how good looking we are and how smart we are. I'm like, this is just amazing that our great grandparents were this good at this,
Yes, I'm really thankful for that, and also to be part of the show. And yes, it is Verum.capital. Our website is very simple, verum.capital. That's it. There's nothing else. And you can find us, and we're happy to chat and nerd out on some weird crypto stuff. So we're happy to do joint research and so on. So I think we're super open and approachable.
That's awesome. Well, and I'm really excited about you being here in December and a little bit into January. We'll make sure when the new podcast studio is done, we'll get some of the real nerds that I know on this kind of stuff all together, and I'll just sit back and let you guys do your thing. There's Adam Small, who's been on this show a couple times. Adam has this every time I put him with really deep crypto DeFi folks, they get into this conversation about what is value. And every time I just sit back and I'm like, I just have to listen, because it's really incredible when you think about what is value. And how does value affect the way that we think about things? So I'll make sure to include you in that conversation, because I'm sure that one will go deep, deep, deep.
Love it.
I'll get 10 episodes in one recording from you guys in the room together. But well, thanks so much. And hey, everybody, thank you for tuning in to another edition of The Convergence. Make sure you check us out, theconvergencepodcast.com. Understand we have both the YouTube channel and we're here on Spotify and Apple. So make sure you consume this in whatever way is best for you. So until next time.
Thanks for listening to The Convergence. If you want more information about the topics you've heard here today, reach out to us at theconvergencepodcast.com.